Welcome back. Thought it might be helpful to spend a little time on yield curve analysis since the current inverted yield curve on U.S. Treasuries seems to be so topical. What we're looking at here are the bonds, the U.S. Treasuries on March 17th, 2020. We have the maturities starting on the left-hand side. The 1-month maturity pays a 0.12% interest rate or a 12 basis point interest rate. The 2-month pays an 18 basis point, all the way up to the 30-year that pays a 1.63% basis point or 1.63% yield, 163 basis points. Now, notice that the slope of the U.S. Treasuries as we move across the maturities tends to slope to the upside. This is what we tend to see in a normal market condition, where the bonds with the shorter maturities pay a smaller interest rate, the bonds with the longer maturities pay a higher interest rate. Now remember, as interest rates go up, the bond price goes down. So what traders are doing is they're buying the short-term bonds. They're very optimistic about the near-term future. So they're buying the short-term bonds and they're getting their yield and they're waiting for those bonds to mature. Now, when we have the bonds of each maturity pay a very similar interest rate, it's called a flat yield curve, which is what we're looking at here, February 8th, 2019. In this case, a 1-year bond pays a 2.43, so does a 2-month bond, all the way up to the 5-year bond pays a 2.44% interest rates. So a very similar level of interest rates across all the different maturities. They don't have to be exact, but we can see the slope here is relatively flat, especially comparing this to what we saw with what we would consider to be a normal yield curve. Now, flat yield curves do not last very long, and they're considered to be an inflection point, and we can expect something probably big to happen with the market. It doesn't necessarily predict whether that thing is going to be good or bad, but in a normal, healthy market condition, we can't have short-term and long-term bonds pay the same interest rates. A flat yield curve usually emerges before a big event. Now, very rarely we will also see what's called an inverted yield curve. This snapshot was taken on September 21st of 2022. In this case, we can see the 1-year bond pays a 4.08% interest rate and the 10-year bond pays a 3.51% interest rate. What this is telling us is traders are selling the 1-year bond. They're selling it. Now, as they sell more bonds, the bond price goes down. As the bond price goes down, the bond market has to offer a higher interest rate in order to attract investment dollars. Conversely, they're buying the 10-year bond. Reason being, and the reason why we know this, is because the yield is lower. And they're buying the bond so aggressively, the bond market is not forced to offer a higher interest rate. It actually offers a lower interest rate because there's so much demand. Now, it's very easy for us to very quickly, we go online and we can assess, whether we have a flat, a normal, or an inverted yield curve. In this case, we can see here the 30-year bond pays a 3.6% yield and the 12-month bond pays a 4.08. The 10-year bond pays a 3.68 and the 2-year bond pays a 4.19. So it very much is an inverted yield curve because the shorter maturity bonds pay a higher interest rate than the longer term bonds. Now, what does this mean? Well, take a look at the 10-year versus 1-year comparison. This is a very popular combination among analysts that watch the bond market. They compare the 1-year to the 10-year and oftentimes the 2-year to the 10-year. Well, the black area chart over here represents a 10-year bond. This is going back to 1990. Now we can see here the yield has come down quite a bit. The blue line represents the 1-year bond yield. In a normal market condition, we expect to see the blue line below the black line. The 1-year bond is below the 10-year bond. However, there are times that the 1-year bond yield will actually drift above the 10-year. This first occurred going back to the late 1990s. And we saw a moderate sell-off, nothing big, but then we saw a major inversion. These red lines coming down show us when that inversion took place. And we had about a 50 basis point, a 0.5%, half of 1% inversion, meaning the 1-year bond was paying half of 1% more than the 10-year bond did. And we can see as the market, obviously in the year 2000, 2001, we had a major market sell-off, the dot-com implosion, And then the market resumed to be what is considered a more normal condition. Stocks recovered, and the 10-year bond again was very much higher than the 1-year bond. Then again, 2006, 2007, major inversion again, as the 1-year bond paid a much higher interest rate than the 10-year bond. Again, around 0.5% inversion. Well, stocks eventually recovered after the 2008 stock market crash, and we saw a relatively healthy market for quite a long time. And then in 2019, the 1-year bond drifted above, only about a little bit less than 30 basis points, 0.3 of 1 percentage point. But most recently, take a look to see what we have here. We have a major inversion between the 1-year and the 10-year. This, at one point, is more dramatic than we've seen inversion going back to 1990, which is as far back as this chart shows us. So we can see here the 1-year bond pays a much higher interest rate than the 10-year bond, much higher than we've seen in the past. Now, it hasn't lasted as long. We can see in the past these inversions sometimes, span the course of maybe almost a year. But we've just started with this inversion, and we certainly, suspect that may be accompanying our weak stock prices we've seen lately. Take a look at it from a different point of view. The blue line represents the S&P 500 going back to the 1990s. Take a look what happened. The inversion of the bond market began in the year 2000, 2001. That very much preceded the majority of the stock market sell-off. The S&P 500 dropped from a level of 1,500 down to around 800. Again, in 2006, 2007, we had an inversion in the bond market, and that very much preceded a huge stock market sell-off that we know of in 2008. Well, an inverted bond market occurred again, and this very much preceded the 2019 stock market sell-off as well. Now, most recently, although stocks have been weak, we see just the beginning, relatively speaking, of an inverted bond market. So we know in the past, going back about 30 years, we only have had an inverted bond market with a 1-year, 10-year combination. This is only the 4th time or maybe 5th time in the past, 30 years. But when it does happen, it's typically a precursor to weak markets. Now, it doesn't necessarily mean that every inverted bond market will, with 100% accuracy, predict a stock market sell-off. But we know that every major market correction that we've seen, at least over the past 30 years, has in fact been preceded by an inverted bond market with a 1 and the 10-year U.S. Treasuries. So we're going to continue to track this very closely, and we'll begin to explore other bond maturities and their correlations to the stock market as well. We hope this has been helpful. We look forward to seeing you back soon.